Ever wonder if you could move your retirement date years, maybe decades, closer? Today on Insibook, we're distilling Rob Berger's Retire Before Mom and Dad into a simple, action-first playbook you can start this week. No lottery tickets, no day trading, just the tiny habits and clear numbers that pull financial freedom toward you. We'll find your freedom number, build a savings rate that actually accelerates, automate investing with low-cost index funds, and slash silent killers like fees and high-interest debt. You'll get quick wins you can do in minutes, like raising your savings by 1% without feeling it, and a step-by-step checklist to keep momentum. If you've ever thought, "I'm behind," or "retirement is too far away," do not skip. By the end, you'll know exactly how to set up a system that compounds quietly, while you live more loudly. And yes, retire sooner than you ever thought possible. Ready to start the clock in your favor? Let's dive in. Freedom with money doesn't begin the day you stop working. It begins the day your choices are no longer controlled by your next paycheck. Picture a life where bills still arrive, markets still rise and fall, and surprises still happen, but none of it dictates what you do next, because you've quietly built a system that supports you. The path to that kind of freedom is simpler than it looks from the outside. It doesn't ask for perfect timing, secret investments, or a windfall. It asks for attention, deliberate decisions, and a rhythm you can sustain, changes that, compounded over seasons and years, turn ordinary incomes into extraordinary options. Start with the idea that money behaves like a team you manage. Each dollar is a worker. Spent today, it clocks out. Invested wisely, it keeps showing up, earning and recruiting more workers through compounding. The game isn't to hoard every dollar or to live in permanent austerity. It's to keep enough on the field, in the right roles, for long enough that the team wins whether you show up that day or not. This is why time matters so much. Compounding loves patience. A slow, steady stream of investments begun now beats frantic heroics later, because what grows the balance isn't unusually high returns or complicated strategies, but the small, relentless math of interest on interest. Freedom is closer than it looks when you switch the question from "how much do I earn" to "how much do I keep?" Income sets the ceiling. Behavior sets the floor. The lever with the most force is your savings rate, the share of take-home pay you keep working for you. A higher savings rate flips the script in two ways at once. It accelerates the growth of investments, and it shrinks the amount those investments must eventually cover. Lower spending lowers the mountain, while higher saving climbs it faster. Even modest improvements matter. Move from saving 10% to 20%, and you've doubled both the speed of compounding contributions and your progress toward the day your portfolio can carry your costs. Think of freedom as stages, not a cliff. The first stage shows up when you're no longer living paycheck to paycheck. You've put a small buffer between you and the inevitable curveballs: car trouble, dental work, a surprise trip. That buffer doesn't need to be perfect. It just needs to intercept what used to derail you. With that safety margin, the mind calms. You stop putting emergencies on credit cards, and you stop paying interest on yesterday's problems. The next stage appears when high-interest debt begins to fall. Every dollar you use to ship to a lender for interest is a dollar that now serves you. This transfer, moving interest payments from outgoing to incoming, is one of the biggest step changes most households ever experience. Debt is both a math problem and a behavior problem, which makes the payoff approach personal. The math says to attack the highest interest first. The heart often prefers the quick wins of clearing the smallest balance first. Pick the approach that keeps you moving because motion itself compounds. Whichever you choose, make the rules visible. Freeze new debt. Consolidate if it lowers rates without extending terms unnecessarily. Automate extra payments to the target account so you don't spend the money elsewhere. Every month, as balances shrink, your cash flow frees up. Redirect the freed dollars automatically into the next priority. This is a cascade. Remove interest from your life, then give those same dollars a new job-building assets that pay you. While the debt snow melts, build your weatherproofing. An emergency fund is not just a number in a spreadsheet, it's the confidence to make long-term decisions without panic. Some prefer a simple target, maybe 3 to 6 months of essential expenses. Others tier it, a small fast buffer while paying off debt, then a fuller fund once the debt is gone. The exact figure isn't sacred. What matters is that it matches your risks and temperament, job stability, health needs, family responsibilities, and that you can reach it without derailing the plan. A half-built umbrella won't keep you dry, a simple, sturdy one will. Now shift the emphasis from defense to offense. Capture your employer's retirement match if you have one. It's an immediate, risk-free return on your contribution. Automate the contribution so the decision happens without willpower each payday. Then, funnel savings to tax-advantaged accounts in a sensible order. When healthcare is a factor and a high-deductible plan fits your situation, a health savings account can double as a stealth retirement account once current healthcare needs are covered. Contributions reduce taxable income, and qualified withdrawals for medical costs are tax-free. In other cases, tax-deferred or Roth options inside workplace plans and IRAs become the backbone. The order and mix depend on your tax bracket today, your likely bracket later, and your need for flexibility. Again, no rigid ideology, just the habit of putting dollars where they'll do the most work. Investment strategy is where many people freeze, imagining a labyrinth of choices. The good news is that simplicity beats complexity for most investors most of the time. Low-cost index funds spread your risk widely and keep costs microscopic, which leaves more of the market's return in your pocket. A basic allocation, broad U.S. stocks, international stocks, and a bond fund, covers more ground than most elaborate portfolios. Set a target mix that fits your tolerance for volatility and your timeline. If swings in stock prices keep you up at night, raise bonds a bit to soften the ride. If you're decades away and comfortable with turbulence, keep more in stocks. Then the most important rule: hold your allocation through the parade of headlines. Rebalance on a schedule, not a feeling. Costs matter because they compound too. An extra percentage point in fees looks minor, but over years, it siphons thousands from the balance. The same goes for taxes. Place tax-efficient funds in taxable accounts, shelter less efficient ones when possible, and avoid unnecessary trading. Think of it as friction. Every bit of friction you remove, fees, churn, avoidable taxes, helps the engine run faster on the same fuel. You don't need to win a single bet. You need to quietly, predictably, keep more of what markets already offer. The target for freedom becomes concrete when you translate spending into a capital requirement. A simple rule of thumb links sustainable withdrawals to portfolio size. For every dollar you want to spend annually in perpetuity, adjusted prudently for inflation, plan roughly $25 invested. If a basic life costs $40,000 a year, aim for a portfolio around $1 million. If you can happily live on less or plan to work part-time on work you enjoy, the target falls. The point is not to calcify life around a single number. It's to clarify the relationship between spending and freedom. Lower the spending, and the finish line moves closer. Raise the savings rate, and the finish line moves toward you. Aim for both, and the gap narrows much faster than most people expect. Spending, then, is not a moral contest between frugality and indulgence. It's a design problem. The three categories that usually decide your trajectory are housing, transportation, and food. Trim all the small recurring leaks you notice, yes, but concentrate force where it counts. Choose a home that fits life rather than pride or fear of missing out. Favor a short commute, or better, eliminate one. Treat cars as tools, not trophies. Buy reliable, used when rational, keep them for years, and let compounding reward you for every monthly payment you never make. Build a simple system for food, a rotation of home-cooked staples, planned shopping, and a budget for eating out that treats the experience as a conscious choice. The discipline here doesn't erase joy. It prevents mindless outflow from eroding your future. All of this, debt payoff, buffers, automatic investing, smart spending, works best when it becomes identity rather than effort. Make the plan visible. Track net worth monthly. Watch debts fall and investments rise. Celebrate the slope of the line rather than the absolute number. Create friction for bad habits. Delete shopping apps, turn off one-click ordering, keep credit cards out of reach if they tempt you. Remove friction for good habits. Automate contributions, calendar a monthly money hour, and pre-commit raises to higher savings before they arrive. In a story measured in years, habits are the protagonist. They carry you through market cycles, job changes, birthdays, and rainy Tuesdays without constant negotiation. Income matters too, and not only because it raises the ceiling. Even small income boosts paired with steady spending can explode your savings rate. A raise is an opportunity disguised as a temptation. Capture it with a rule. Whenever income rises, increase contributions before lifestyle has a chance to soak it up. Negotiate at work, add a skill that increases your value, or run a simple side business that throws off reliable cash. The more you separate income from hours, royalties, small digital products, consulting with recurring retainers, the more optionality you build. But don't let the pursuit of more income make the plan brittle. Rest, family life, health, and curiosity are the raw materials of resilience. The journey to freedom runs through markets, so you'll meet volatility. Prepare now for the feeling of seeing investments drop on the screen. It's easier to hold an allocation through storms if you've rehearsed the narrative. Drawdowns are the price of admission for long-term returns. The cure for anxiety in those windows is not constant tinkering, it's adequate cash for near-term needs and a bond allocation that lets you sleep. Consider a modest cash buffer for spending in retirement and a rebalancing rule that gradually channels bond interest and dividends and occasional trades back into the target mix. The plan isn't to avoid storms, it's to sail through them because the ship is built for weather. There's a debate you'll encounter around mortgage payoff versus investing. The answer lives in the tension between math and temperament. In many periods, investing the margin has won on paper. Paying off the mortgage has won in sleep and flexibility, lowering required income and reducing risk during downturns. If you're unsure, split the difference. Contribute enough to retirement accounts to capture matches and reach your savings goals, and send extra to the mortgage as your emotions prefer. What matters most is that the decision reinforces your commitment to stay the course rather than tempting you to second-guess every headline. Insurance is the unglamorous part of the plan that makes every other part work. The goal is never to get rich off insurance, it's to avoid getting poor. For most households, that means straightforward choices. Term life insurance when dependents rely on your income, disability insurance to protect your earning power, appropriate health coverage, liability coverage through auto and homeowner policies, and, when you've built assets, an umbrella policy. Skip the flashy products that combine investing with protection and charge for the package. Keep each tool in its lane, investments to grow wealth, insurance to guard it, and you'll spend less and understand more. Taxes don't go away, but they can be managed. Contribute to tax-advantaged accounts while you're working, and think ahead to how withdrawals will be taxed. Diversify the tax treatment of your future income streams. Place funds that tend to distribute realized gains in tax-sheltered accounts when possible, and keep broad, tax-efficient equity index funds in taxable accounts. In retirement, be strategic about the order of withdrawals, and consider opportunities to convert some tax-deferred money to Roth during low-income years. None of this requires a complex, bespoke strategy. It requires a small amount of planning and a habit of paying attention. The so-called finish line, reaching a portfolio large enough to support your spending, is not an abrupt switch from work to leisure. It's a migration. Many people keep working in new ways after reaching financial independence because they like the work or the impact or the camaraderie. The critical shift is that work becomes a choice rather than a necessity. When work is optional, resentment fades, courage grows, and projects that once felt risky look like experiments. You can volunteer, launch something small, mentor, consult, travel between sprints, or take a sabbatical without fear because the bills are covered by the system you built. A useful way to measure progress is by asking how many months or years of current expenses your investable assets could cover today. That number climbs as debt falls, as spending normalizes around your values, and as investments compound. Watching it grow turns an abstract idea, retirement, into a present tense reality, freedom. Even at the early stages, the feeling changes. With a few months of expenses in the bank, the job that once felt like a trap starts to feel like a choice. With a year, you negotiate differently. With several years, you take a break to study, move closer to family, or start a small company because the downside doesn't threaten your home or your groceries. Lifestyle inflation is the invisible headwind. It rarely arrives as a splurge. It arrives as 100 painless upgrades, better phone plan, nicer furniture, more frequent ride shares, a subscription added here and there. Left alone, these small changes crowd out savings and push the finish line away. The antidote is not denial, but intention. Choose a baseline you love and keep it. When you spend, do it loudly and joyfully on what matters to you. When the itch to upgrade comes from comparison or boredom, let the feeling pass. Money saved isn't deprivation when it buys you years of autonomy. Parents and families face a different set of choices. Freedom for your household often means covering the basics first: stability, insurance, and emergency funds, then layering investments on top. College savings can be part of the plan if it fits your values and resources, but don't fund a distant expense at the expense of your near-term security. Modeling healthy financial habits for children, budgeting together for a trip, explaining why the family drives a paid-off car, showing how investments grow, is often worth more than maximizing any single account. The culture you build at home around money, work, and generosity shapes the next generation's starting line. Generosity appears in every stage of the journey. Give now in small, regular amounts if it aligns with your beliefs. Give time and attention to people who need them. Plan to give more later if that excites you. Freedom amplifies generosity because you're less afraid. When the basics are covered, you can lend a hand, back a friend's idea, or support a cause, not from guilt, but from strength. This too is part of the point. Financial freedom isn't a scavenger hunt for status tokens. It's space to become the kind of person you want to be. There's also the reality that plans meet life. You will encounter layoffs, illnesses, bull markets, bear markets, births, moves, and moments of doubt. The response isn't to build a plan that pretends to foresee every twist, it's to build a plan that survives them. That means flexibility in spending, liquidity in reserves, humility about returns, and routines that function even when you're distracted. In good times, the plan captures the tailwinds. In bad times, it prevents overreaction. Over long spans, resilience beats precision. If the map still feels theoretical, turn it into action with a short sprint that rewires your defaults. For the next 90 days, track every dollar that comes in and goes out. Not to judge yourself, but to see the truth. Choose one big improvement in each of the 3 heavy categories: housing, transportation, food, and set a specific target. Cancel or renegotiate subscriptions. Bring a lunch a few days a week. Sell the rarely used object that carries costs. Automate at least 10% of your take-home pay into investments on payday and build from there. Set a reminder for a monthly money date with yourself or your partner to review accounts, reaffirm the plan, and reset goals. These are not dramatic gestures. They are the bricks in a wall that will keep out the storm. As investments grow, consider the psychological side of seeing larger numbers. The larger the pot, the stronger the temptation to outsmart the market or protect every dollar from every dip. Protecting against the urge to tinker is part of the system. Write down your investment policy in plain words: what you own, why you own it, how often you rebalance, and under what circumstances you might change your allocation. Then stick to it. Markets reward patience. Your future self will look back gratefully at the version of you who kept faith during a volatile headline cycle and let compounding do its quiet work. When you do reach the point where investment income can shoulder most or all of your spending, pace your withdrawals prudently. A flexible range, spending a little less after poor market years, a little more after strong years, can extend portfolio life and reduce stress. Tie spending to what actually brings satisfaction rather than the old scripts of consumption, and spending levels often settle comfortably below worst-case scenarios. Remember that the toolbox includes more than stocks. Social safety nets, part-time income, rental income, and pensions can diversify your sources and lighten the load on your portfolio. Along the way, guard your attention. You will be sold new funds, new apps, new systems, and new narratives. Most of them add complexity without adding value. Your edge is boredom, being willing to execute the same simple plan with care, month after month, while others chase novelty. Your edge is realism, knowing that a plan you can live with through a downturn is superior to a perfect plan you abandon at the first storm. Your edge is gratitude, remembering that you get to do this, that every contribution is a gift to your future self, and that the journey is not a race against anyone else's timeline. If you ever doubt whether these small choices matter, run the mental experiment. Imagine 2 versions of your life 10 years from now. In the first, you saved a modest amount sporadically and upgraded your lifestyle whenever income rose. You have nicer things, but you also have the same dependence on next month's pay. In the second, you set a high savings rate early, funneled raises into investments, kept life delightfully simple, and avoided interest payments where you could. Your portfolio is larger, yes, but the bigger change is invisible. Your decisions feel lighter because your future is funded. Neither path required a lottery ticket. They required different habits. Retiring. Before mom and dad is not a boast or a rebuke. It's a statement of possibility. Earlier generations built their plans around defined pensions and long tenures at single companies. Today, the scaffolding is different, but the core remains. Live below your means. Invest the difference in things that grow, insure against catastrophic loss, and give yourself the gift of patience. The system may be simpler than the world around it, but that's the point. Complexity is what sells. Simplicity is what compels results. If you're starting late, the principles don't change. The levers get heavier, but they still move. Trim bigger, save more, avoid errors, and keep your attention on what you can control. If you're starting early, don't waste the greatest asset you'll ever own: time. A decade of consistent investing in your 20s or 30s can do the work of 20 years started later. The path is available to both, and the feeling of progress is available today, not years from now. The blueprint, distilled, looks like this when it's lived. Make a snapshot of where you are. Eliminate high-interest debt with focused aggression. Build a cushion so small, emergencies stay small. Automate investing into low-cost, broadly diversified funds. Set an allocation you can hold in all weather. Reduce recurring costs in the big categories. Raise income when you can and lock in the gains with higher savings. Protect the plan with simple insurance and sensible tax decisions. And revisit the process at a calm, regular cadence. That cadence becomes a beat you march to, not a sprint you collapse from. The result is not merely a larger account balance, it's the alignment of your days with your values. Eventually, the math catches up to the behavior, and one day you'll notice you are living the freedom you hoped for. You choose your projects, you decline obligations that don't fit. You take time for people who matter. You're still ambitious or curious or industrious. Those traits don't vanish when money compounds. But you're ambitious on your terms. The world doesn't get quieter, exactly. You do. There are still bills, taxes, maintenance, surprises, and decisions. What's changed is the base layer under your feet. It's solid, built from thousands of small, consistent actions that looked unimpressive in the moment and miraculous in hindsight. That's the real promise behind retiring before anyone else's timetable. Not a contest to see who can quit first, but an invitation to stop outsourcing your life to financial accidents. The tools are ordinary. The results over time are not. Choose a life-sized home. Drive a paid-off car. Cook more. Track your money. Pay yourself first. Let compounding work. In a world that celebrates the dramatic, you will have chosen the durable. And one morning, you will realize that your work is optional, your time is yours, and your future is no longer a negotiation. The team you've spent years building, the one made of all those small, obedient dollars, will be clocking in on your behalf, whether you do or not.